My title of my talk is, In What Way is America Truly No Longer Great, and Why Does This Matter? Now, when the election outcome was known to everybody, suddenly it was the case that Americans were unanimous. Yes, we all agree America is no longer great. But the rest of the world was scratching its head and sort of saying, what are you talking about? You're the biggest economy in the world, 25% of GDP compared to 17% for China. You have by far the biggest and most powerful military, and you're always in the vanguard of innovation. And I agree. I think it's BS that America is no longer great. But there is an important way that it is no longer great. And my talk will home in and explain why this spells the end for something which I'll tell you later. So, a blast from the past. It's actually been 30 years now since I moved to the United States from my brokerage firm job as an analyst and started an independent newsletter. It was called the Kaiser Bottom Fishing Report. And this came out every 2 months. It was a paper product, snail mailed, and cost 99 US, which is about 200 US today, inflation adjusted. And the 1996 Bottom Fish collection of 100 companies was perhaps the best one ever. Today, things have changed an awful lot. In April of 1997, after the fabulous Voisey's Bay nickel discovery, earlier the diamond discoveries, the discoveries in the third world frontier, such as Arequipa in Peru. And of course, there was Indonesia's Busang discovery by Briex. But in April 1997, when that blew up, I had 3,500 subscribers. Today, with a product that costs $450, that's available online, that is a research platform that covers all the companies, it has collapsed back to below 100 subscribers. So this whole idea of the independent newsletter writer, subscription-based, it is something that is failing. So here I'm going to walk through why this whole sector, this bear market that began in 2011, continues to plod along. With this graphic, the red here is the total value of resource sector financing on a monthly basis. And you can see this is the China super cycle funding. This is the gold cycle after the crash in 2008 when gold marched all the way to $2,000. Then that long bear period and a brief interlude here. And then the sort of post-COVID when gold finally breached $2,000. But you can see this has faded and we're kind of flatlining. The blue is the resource value traded by TSX Venture Resource Listings. And you can see the trading activity closely tracks the financing activity. Not so much with the non-resource stocks, which since about 2013 have come to dominate TSX Venture Resource speculations. You can see these incredible spikes at these various periods. But right now, after several dreary years, I mean, the last hurrah we had was in early 2022, it's now even fading in January. Trading value in January is even lower than it was so far in December. And this is there's no January effect. There's none of this, okay, the tax loss selling is over. Let's get ramped up again and excited about the new year. This graphic is a similar graphic. This time I've split the financing amount raised in each month between the blue, which is for discovery-oriented juniors, and pink or violet, whatever that is, for the feasibility demonstration companies. And you can see how during the China super cycle, feasibility demonstration was what all the money went into, and also pretty much in the gold cycle from 2009 to 2011. This was all these ounces in the ground, pounds in the ground that were dragged into the money by significantly higher real prices. And then you can see this strange period here where, again, feasibility demonstration. This is the so-called Cisco windfall effect, where a few companies were able to raise enormous amounts of money to drill 1.8 million meters into a deposit to get it up to about 7.5 million ounces, and they were vindicated. They were just bought out by Goldfields, which had acquired half, bought the other half, put a $4 billion Canadian price tag on it. So some of these things are all being absorbed right now. But you can see that in sort of mid-2020 after the COVID thing, the financing focus went to discovery exploration companies. So people stopped hoping that higher metal prices would drag existing deposits into the money and start saying, well, I guess we're going to have to throw the money at juniors who will find something that's really, really, really good at that. You know, copper lumbering along forever at $3.50 to $4, or gold lumbering along at $1,800 to $2,000. And this is a sort of another version of I've broken down the monthly financing activity for TSX Venture Resource Juniors by the sort of value range. And you can see that in the past decade, it has really shifted to a small group of very large financing. So this is being done by the financial sector. It gravitates towards the more advanced, bigger companies. And the smaller juniors, the amount of money that they're raising in the 5 million or less, it's kind of flatlining. And this is not really a healthy thing. And something else, you look at these total numbers, and you look at this, you think, well, it's not so terrible. But when you apply inflation to everything, it's a serious problem because the compliance costs, the permitting cycle costs, everything costs an awful lot more than it used to, and a lot more than CPI inflation adjusted. So the whole sector, especially the junior ones, the smaller ones, they are being starved of capital. And this has led to this terrible situation, which is all the TSX venture-listed resource companies broken down into working capital ranges. And this group, just under 50%, have negative working capital, about $2.4 billion, money that will never be repaid. And this group is the one that's still alive. And you can see it's quite a small group. This group's kind of interesting too. They don't have enough money to do anything interesting, but if we ever get a change in this bearish mentality, this group could finally get some support and perhaps join back into this. But really, the sector needs to lose half of its listings just to consolidate it, because the real problem is that the audiences have vanished. I get to celebrate my 65th birthday in a few weeks by having cataract surgery. I'm one of the last last people of the boomer generation. By 2030, all boomers are 65 and over, and they are losing interest, which is normal. As you get older, you don't get excited about these sorts of things as much anymore. But what is really bad is that there are no younger audiences coming in up behind us. The Gen Z, the millennials, the Generation X, they don't care about this sector. They're into stories where you don't need to know anything, which is why Bitcoin is perfect. Well, you do need to know something. You need to know that when you buy Bitcoin, there are an awful lot more people that have a much lower cost base than you. Plus, you need to have blind faith that there are a lot and a super abundance of people stupider than you out there who will eventually buy your Bitcoin from you. So the resource sector requires a lot of thinking, and the resource sector plays out over time. And we've also had the issue that we have structural problems. The financial sector is asset gatherers. So they aren't really interested in doing financings except with the much bigger companies. We've got a regulatory culture that's out of control, that's explicitly hostile towards the resource juniors. They don't care what cannabis companies or crypto companies say, but they do care if there's some slight wording wrong in a press release. They rake the company over the coals. We now have a horrible permitting cycle in Canada since Trudeau signed on to UNDRIP and basically turned the First Nations into an aristocracy that has a dominion over Canada's natural resource future. All of a sudden, the permitting cycle has bogged down terribly. So we have now this problem of financing cycles, permitting cycles, and seasonal cycles not coordinated anymore, which drags everything out interminably. And that, of course, further deters new audiences from discovering this space. And in addition, we have this wonderful institution of being able to sell on a downtick with only the intent to borrow, sell short. And the algos for these financial firms, one of them, which was just fined $3 billion for condoning money laundering, they just sit there and harvest the buying when some company puts out a news release after waiting 2 months for assays, starts to go up, boom, they sell into it, they sell short, the buying dries up, they say, okay, we can't borrow the stock, so we need to cover it by the end of the day. So they then lean into the order book, sell into the bid, and cascade the longs into a fit selling of despair so that they can cover their intraday shorts and walk away with their little peanuts that they have scraped out of the system. And in this process, they deny the ability of price discovery. They deny companies to gain incremental value increases from results that aren't barn burner results, but that push you closer towards the prize that you're stalking through a, vectoring drill strategies. So, anyways, I don't see any fixes for this. And last year I said, I've been doing this over and over again, and I'm going to be certified insane if I continue to do it expecting a different outcome. And I said, I need to pack this in. This is not working, and nothing's being done to actually help this resource junior sector out of its funk. But then, when I saw the election outcome, I said, this problem, this one area where America is no longer great, it's going to become a crisis a lot sooner than it would have if, say, Kamala Harris had won the election. It was going to happen anyways, just not as fast. So I am going to stick it out. And this chart is the, thank you. This chart is based on data that the USGS publishes. They've been doing it since 1930. It's available free on the website. You just got to compile it and create charts like this. During Trump's first term, the USGS became very concerned about America's dependence on importing these raw materials. Not so much energy. America's the biggest producer of oil and natural gas. That's not really a problem. But it's everything else. Look at the blue is what percent of global production the United States produces. And the red is the share that Russia and China combined. Now, how did this happen? Well, after the end of the Cold War in 1991, globalization really became a thing. And this helped China grow, and jobs and stuff moved everywhere else. We were exceptional. We don't want dirty mining in our backyard. Let it be done in Congo or China or somewhere else, and we'll just buy the stuff and grow our economy. And eventually, China will become just like us, and everything will normalize, work out, and it'll be okay. Except China has not become like us. And that became very clear in February 2022 when Russia invaded Ukraine, and Xi Jinping stood up and said, "We are super buds forever." They basically formed a Global East alliance opposed to the Global West, and other members like North Korea and Iran are part of this Global East alliance. And they are now in a grand competition with the Global West to garner the attention of the Global South, make the Global South part of the Global East, and isolate and diminish the Global West, with, of course, America the top target. And to understand this, consider the green are all the Global West countries, and their GDP is about 52%. The Global East countries, they're about, 20%? And then the Global South are about 9%. So when you look at this next chart, this is Global West raw material supply, this is Global East, and the rest is Global South. So if Global South starts throwing its lot in with the Global East, we have a serious problem. And this problem is going to be accelerated because Trump has not only declared war on the global East, except maybe Russia, but he is also declaring war on everybody else, including his global West allies. And this is going to end up with the United States isolated, with everybody figuring out how to work around the world's biggest economies in order to keep their own economies going. And here's I mentioned earlier about the energy. Energy is even more important than metals and minerals. You can see that China's very weak in natural gas and oil, whereas the United States is basically a top producer. And in coal, China is super strong, and they don't have much uranium, but Kazakhstan is the biggest producer. And if push comes to shove, who's Kazakhstan going to ship its uranium to? To America or to China? And again, with this coal-fired thing, China has now sold over 50% of its car sales are electric vehicles. It owns the electric vehicle future. And is it because it's big clean energy transition type country? Well, no, they have a super oil import dependency, and getting away that one way that the United States can strangle the United States by choking off the flow of oil to China, this has been their strategy in using government support and everything to build the EV market. And they'll go, develop nuclear also, because they are aware that coal power is not good, and they do want to inherit the future, and they want to make sure it's a future worth inheriting. So this group of charts, I've arranged them in my website based on intensity of production concentrated in a single country. These ones are all China. Well, you can see these are all China. China dominates in all these metals. The ones with an X are ones where they've already imposed export controls. That's graphite, which truly doesn't matter because you can make synthetic graphite from petroleum refining coke, which is a waste byproduct. That's not really a big deal. But germanium and gallium, these are tiny markets, but they're critical to the whole semiconductor industry future. And antimony, which is important for the military, and they dominate in that also. But then you have things like tungsten, vanadium, and rare earths. And with rare earths, they're already fooling around creating this paperwork requirement for exporters to figure out what the importers are going to use it for so they can shut down, oh, it's going to the military. Well, that's not going to happen. So there's already implicit restrictions coming. And tungsten, of course, is the tool industry metal. And again, China dominates in it. So when push comes to shove, we're going to have a problem with these metals suddenly not being available. Now, here's ones where they're not so big. Zinc, they're quite big on. And when zinc, when China gets into a conflict, there's not going to be as much zinc coming. And because they also produce a lot of lead, you're going to see, with lead becoming dead because EVs are replacing ICE cars, there's going to be a surplus of lead. The price will collapse, and zinc mines that depend on their lead component are going to be in trouble in the future. But copper's the interesting one, and that is because United States is a pretty big producer. They've got the 6% or so. But in North America, Mexico, Canada, and the United States produce enough copper to supposedly take care of themselves. But their GDP together is 29% of global GDP, but their combined copper supply is only 11%. Now, we've heard from the energy transition crowd that copper supply will need to increase 50% for EVs and all that kind of stuff. Now we're kind of starting to hear from the ones that say, well, energy transition's dead, the world's going to keep heating. Air conditioning requirements of copper are going to go through the roof. And of course, with the big AI boom building these data centers, which require ever more electricity, that's also going to be an additional source of copper demand. So America's ability to feed its own copper needs could end up compromised if the conflict with Russia, China, gets hot, and the global south, Chile and all these, Peru and all these places. I mean, China has their mitts into these South American countries. It also has its mitts into Africa. It's a reason cobalt prices haven't gone to the roof, because Congo has all these Chinese companies operating there, and they know how to keep the peace and keep the supply going. So I've got 5 companies in my session. They're all part of my 2025 favorites collection. In the case of P2 Gold, they have an American copper gold deposit. It's not, an off-the-scale Congo, Kamoa, Kalua type copper deposit, but it's the kind in a location where if we start seeing America push the button and say, we need to develop a domestic supply of these metals and minerals that we're deficient in relative to our GDP needs, this is the kind of story that's going to start getting attention in the market. Then we have PJX Resources with its Dewdney Trunk Trail project, which has the sort of footprint and tantalizing evidence of another Sullivan II deposit, perhaps even with that scale. And of course, Sullivan was a great source of germanium, plus a lot of other metals such as indium, in which China also dominates. So this is an exploration play, and this could be the year, after being hung up by permitting delays last year, that this company finally delivers the sort of old-fashioned discovery that gets even perhaps younger audiences excited. And then there is VR Resources, which is a perennial generator of interesting new targets. They don't farm it out. They raise money, spend their own money on it. Their newest venture is what they call West Wabigoon in Western Ontario. And I'm going to let Justin Daly tell you why this is interesting and why it has people like me, because it was 40 years ago that I got dragged into this sector when Hemlo was discovered. Is the past going to repeat itself? Is this blob, is this blob sitting on a 20 million ounce Hemlo deposit that's been obscured because everybody thought this area was useless? Or is it perhaps something like the Hammond Reef deposit to the west, which is low grade, but with gold at 2,700, still pretty good. And then there's Solitario Resources Corp, which has also been fighting the permitting obstacle. And in the United States, unlike in Canada where they've created this First Nations consultation obstacle to getting anything done, try and sterilize the country as a park that no longer produces minerals. By the way, these threats Trump makes about taking over Canada, making it the 51st state, I don't think that should be taken as a joke. Trump may not know it yet that he has a metal supply problem looming, but when that starts to bite hard, he's going to look south at Mexico and find that that would be a mess to take over. He's going to look north at Canada and see its enormous unexploited bounty all paralyzed because it's become bogged down in this reconciliation strategy to keep Canada apart. And he's going to send the tanks across the border and say, you First Nations, you other Canadians, you're all conquered people. UNDRIP's gone. You're going to do as we say. We need your raw materials. So I think Canada right now should realize the danger that's brewing and encourage the First Nations to collaborate rather than obstruct. Get rid of the people who are using this as a strategy to sterilize Canada's resource production potential and get things moving before Trump wakes up to his problem. And I think when they do wake up in 2026 to their own problem, you're going to see the U.S. Forest Service and BLM be told no more of this behaving like a health insurance company, deny and delay, deny and delay. No, just do it. I mean, I had one story of a company that finally got permission to drill some holes, and then got a call from the U.S. Forest Service saying, you jerk, you didn't drill where you were supposed to. I went to your site and there was no evidence of any drilling. And of course, the professional companies know how to reclaim their stuff properly. So this is not really a problem at the exploration level. Fast-tracking exploration, making sure that companies stick to their requirements, that's the way things need to change. Anyway, Solitario this year last year, finally with the first drill program, made a significant discovery which which Chris Harold will tell you about. I don't have time here, but the market ignored it because it doesn't understand geology. And if they get their Ponderosa plan of operations approved by the time summer rolls around, well, that's one where it's almost guaranteed that no-brainer discovery holes will be pulled. And then just on with gold in perspective, gold is over $2,700. If you take 400 gold in 1980 and inflation adjusted, it should be, what does that say, 1581? But at the current price, it's up 72% in real terms. Real price gains in gold matter, not the nominal amount. If inflation is going through the roof because of fiat currency debasement, the costs travel along right with it, and you don't make any money from this sector. But the market is completely ignoring this. Where's the buying coming from? So here's the GLD. It's flatlining. Sure, when COVID hit and they were going to print a whole bunch of money, they got all excited and bought the GLD. North American and Europeans are not buying GLD. They are probably not buying physical gold. Who is buying physical gold? Well, when you look at what the central banks are buying, that's not enough to explain gold ramping up 26% last year to make a record high. No, it is much more hidden entities that are buying gold because they are preparing for this showdown between global East and global West, where the US dollar starts becoming irrelevant because nobody's trading with it anymore. But nobody wants to load up on each other's currencies because the US dollar is still the greatest reserve currency out there. But gold is that alternative place to park it. China just reported a record $1 trillion trade surplus. What do countries with a trade surplus do? Well, they end up buying the bonds of the company that have the deficit. And so everybody's kind of happy it goes around in a circle. Well, they've whittled their US reserve of treasury bill holdings to $1 trillion. They're still sitting on that much, which they could try to unload on the market. But I think that they are recycling the trade surplus into gold purchases. So when push comes to shove, I think we'll see gold go higher. But right now, you look at the gold producer index that I've got. When I started it in January 2020, it's up only 53%. During the same period, gold's up 78%. And if you look at the index of all the whatever the 40 companies are in there, yes, it gained 30% last year compared to 26%, but that's garbage. These companies are supposed to go way up when gold goes up somewhat. So this whole narrative has broken, and we are now trapped in this situation where these companies are not getting validations. And the juniors and the developers, such as Vista Gold, they barely budged last year. So this is the big bet right now. What will cause the market, Western markets, to start to believe that 2,700 gold and higher is the new reality, rather than this suspicion that Donald Trump is going to sell America's 250 million gold reserve ounces in Fort Knox and use it to buy Bitcoin instead and tank gold back below $2,000. I don't think that's happening, but it seems as if the market thinks gold's going back below 2,000, where, yeah, stocks have, really shouldn't have done more than they have done. So Vista Gold is like the ultimate proxy for betting on this turnaround in perception, because it's not like the last 30 years we said, oh yeah, this stock will be worth a lot if gold goes to $2,000 type of thing. Well, no, gold has already gone up way in the money. This company is being priced like there will never ever be another gold mine in the world. So there's your leverage here. Their base case price is here. They're trading at 60 cents, and it's the NPV per share values there. The current price is way up here, 17 to 20. And if we get gold going to 4,000, look what happens. There's going to be an inflection. And when that inflection happens, you're going to want to already be long a Vista Gold type of company. Because what's the value of all these gold companies? What, $50 billion or something pathetic like that? Bitcoin's worth $2 trillion. The gold market itself is about $15–16 trillion as an asset class. To move those significantly higher, that requires a lot of capital inflow, but it will not require much to move this small gold producer, developer, and explorer community. And change, as I said, what am I doing differently? I decided to stay in the game, but I do not want to be certified insane. The current 450 membership will be available until March 31st. Then it is gone. After that, it's $200 a month or $2,000 a year, aimed more at high-end type investors. And of course, those of you who don't subscribe now, if I'm proven right, say by 2026, you'll be happy to pay $2,000 a year because this space will be super, super hot again. And the Kaiser watch, which has been sort of free, it still will be free as audio, but what the written version will remain on the KRO platform, restricted to members only. But to try and tackle or access this younger audiences, I've now created a Kaiser watch Substack subscription system. The Kaiser watch general comments will be posted free there. The ones that are company specific, they will be restricted, and it'll be a cheap price of $10 or so a month type of thing, going back to 1994 when I started with a $99 product, except everything is a lot better, and we're heading into a major, major bull cycle because this crisis, this supply crisis America and the global West in general are facing, that is going to become top news soon. And the juniors, they're the ones, we need hundreds and hundreds of them, not 6 majors trying to figure out where hidden deposits are. It's hundreds and hundreds of juniors, competent juniors, all out there exploring, creating the statistics that allow these discoveries to happen. So anyways, I have this year's 2025 favorites. I've done three parts to it. That's all unrestricted. You can find out what they are. I've got good descriptions of them. I think it's a fabulous collection. I'll be using this to try and attract Gen Zs and millennials to understand the sector. Hopefully that starts to work by stocks actually going up. And I have 100+ companies in my bottom fish collection, which is way better than the one I published for 1996. But you can see where it's focused. I'm avoiding this part of the world, this part of the world. Australia's good, but they got a little bit of South America. Resource nationalism, all these problems are limiting these areas. But right now, we're suffering because NIMBY in America and reconciliation in Canada are blocking the funding and advancement of exploration. But I think the conditions will change that soon. Thank you.